Hi there, and Happy New Year. Welcome to the January 2024 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. December was a strong end to a very strong year. Markets around the world were up by from 3 to 6% for the month and high single to low double digits for the quarter. For the year, markets were up by double digits across the board, with the U.S. and the NASDAQ in particular leading the charge. Even fixed income managed to finish the year strongly, taking it from a loss to a gain. It was a month with green across the board. And the main driver of this was, once again, the recession that we keep not seeing. While we did see growth slow somewhat, and that's continued to pull inflation down, we also saw job growth continue at healthy rates, and we saw consumer confidence recover much of its earlier decline. And that left both income and spending growing at a steady rate all through the year. Even the Fed, which kept interest rates steady at its December meeting, seems to think we may be getting the soft landing everyone's been hoping for. And those growing hopes of a soft landing took interest rates back down last month, with the U.S. Treasury 10-year yield dropping from over 4.25% to under 3.9%, taking stocks and bonds even higher at year-end. But with the economy seemingly headed into a soft landing and with inflation continuing to decline, the real question is whether the Fed will cut rates next year. Markets now expect about 6 rate cuts, while the Fed itself is only looking at 3. So there's a big gap there, and that is a risk to markets. If inflation were to reaccelerate, markets could react pretty badly. And that's now the biggest risk as we enter the new year. Beyond that, of course, we also have international risks very much in play, with instability in the Middle East threatening trade routes and supply chains. And that's even before we start to think about next year's elections. We've still got a lot of things we can worry about. But despite those very real concerns, there are some bright spots. Corporate earnings came in better than expected last quarter and should keep growing with the economy. The decline in interest rates last month should help support valuations going forward. And after a very strong year like 2023, the momentum tends to continue. With the economy in a good place and with earnings growing, the market foundations are still in pretty good shape. So on the whole, we're still in a good place as we enter the year. And that's also a good place to end this update. Thanks for watching, and I'll be back in February for the next one. Until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And have a happy new year.